Welcome to this quite important forum of the CIS. This follows up one we held 2 years ago called Trans-Atlantic Fiscal Follies. At the time, it was October 13th, I think, 2 years ago. At the time, it was sort of not so much in the wake of the global financial crisis, but certainly we're right in many ways. We're right in the middle of it, and the two speakers then were Robert Carling and Oliver Hartwich, and they both decided to talk about aspects of what was going on in Europe and North America that were giving us cause for concern. Obviously, since that time, things have settled down a little bit, but is it back is the question where I guess we're going to ask tonight, and everybody here can have their chance to have their say. All three speakers tonight are from the CIS team. Robert Carling is a senior fellow, and Oliver Hartwich and Adam Creighton are both research fellows they're all in our economics team. So without further ado, I'll invite Robert Carling first to speak to us. Robert, thank you.
Well, thank you, Greg. You know that something must be wrong if America's fiscal problems can make almost as much news in Australia's mainstream media as our own federal budget does. And we planned to hold an event like this here a couple of days after our federal budget recently in May, and there wasn't sufficient interest. So amazingly, tonight we get this level of interest in the budget of another country. So people are talking loosely about a debt crisis in the United States, but I will argue that there is no debt crisis yet. Rather, there is a crisis of government reflected in a huge budget deficit between expenditure and revenue, which, if not corrected, contains the seeds of a debt crisis at some unpredictable time in the future. And if there is going to be a financial crisis of epic proportions within the next few months, as some people are predicting, I think the epicenter of that crisis is more likely to be on the European side of the Atlantic. But of course, its consequences will be felt far and wide. Now, a few facts and figures about US government debt and other fiscal variables, past, present and future. The gross federal debt of the United States is likely to be about $15 trillion at the end of this year, or close enough to 100% of their gross domestic product. And excluding debt that the government owes to itself, or so-called intra-governmental debt, the figure is around $10.5 trillion, or 70% of gross domestic product, for what they call debt held by the public. And I've put this slide up just to show you what $15 trillion looks like on paper. There are an awful lot of zeros, and I think that $15 trillion is 15,000 billion dollars, or 15 million dollars. And you can see there that the expenditure of the US federal government is 3.7 trillion, and their revenue is 2.2 trillion. But these figures are difficult to comprehend, and I've reset them simply by dividing by the number of households in the United States. There are about 116 million households in the US. So these are the equivalent figures per household. You can imagine, and I don't want to overstretch the analogy between household and government budgets, but this just is a scaling method. So expenditure per household of almost $32,000, and this household is spending $32,000 even though its income is only $19,000, and it has a debt of $90,500, and that debt has been run up not because it's accumulating more assets, but because it is just spending more than it is receiving each year. So it's like a credit card debt. Now, looking backwards, having debt of 70% of GDP has been seen before, but only as a result of World War II, after which it declined over many years to a manageable level. On this occasion, the US is not coming out of a world war and into a long period of strong economic growth, which was a very favourable set of circumstances. On this occasion, a much less favourable set of circumstances prevails. Instead of shedding the burdens of a world war, the US is living with the hangover from a financial crisis that is going to weigh heavily on economic growth in the US for years. Now, we are currently about here. So just ignore this for the moment and look at the history, and you will see that here it is still slightly below where it got to during World War II. And this graph, which I've taken, by the way, from John Taylor, the US academic economist, this goes way back to when George Washington was president. And you can see the impact of the Civil War and the First World War, the Great Depression, the Second World War, and so on. And each time you get an uplift, and then it goes back down. This time, this is the uplift as a result of the global financial crisis. And this is the projection to the year 2085, based on the existing policies. And of course, this is unsustainable, and as somebody once said, if something is unsustainable, it won't happen. But it's just useful to show that arithmetically that would be the consequence of existing policies being maintained. So as you see, beyond where we are now, basically, projected debt levels spiral upwards, and they do so for two reasons. The cost of the public pension and healthcare schemes will increase rapidly as population ageing intensifies. And secondly, the public debt interest bill would rise exponentially as ballooning deficits, debt and interest payments feed off one another. And underlying these long-term projections would be a massive expansion in the size of the federal government from around 1/4 of gross domestic product now, which is already a peacetime record, by the way, to 1/3 by 2035 and over 40% by 2050. So the US would be on a path to become more like the 50-50 mix between the public and private sectors that now prevails in many European economies. How much debt is too much? Well, as you see, it is often expressed as a percentage of GDP, but this is done mainly to facilitate comparisons over time and between countries. In truth, nobody can say with precision what percentage of GDP is sustainable for any particular country. It depends on each country's circumstances, such as its rate of growth, the debt, the maturity profile of its debt, the rate of interest that it has to pay, and so on. And at the moment, by the way, the US Treasury can borrow for 10 years at 2.2%, and for 30 years at about 3.5%, which hardly are figures suggestive of an existing debt crisis. There is no identifiable tipping point for debt as a percentage of GDP, and nothing magical about 100%. Ultimately, the bond markets decide when enough is enough, and they can do so seemingly out of the blue. Crises tend to unfold rapidly and unpredictably, not gradually or in a linear fashion. All I think we can say at this point is that the US public debt has entered a danger zone, and that if it remains on its current path, a crisis will occur at some time. Whether that is next year or next decade, we cannot say. And there is less concern in the markets about the current level of debt than about its projected path and the failure of the political process to deal with it. The more it appears that politicians are failing to grapple with the problem and that the projections will become reality, the more probable a crisis becomes. And I think that is what Standard & Poor's recent credit rating downgrade of US Treasury debt was saying. What is the size of the task that they face? In business language, the US government needs to deleverage. And economic growth will help, but there is pretty well universal agreement that economic growth on any realistic scale will not be enough on its own to cut into the debt burden enough. Action is needed to cut spending and or raise taxes. The size of the adjustment depends on the target level of debt and when the adjustment is made. The Congressional Budget Office has calculated that an immediate fiscal adjustment of about 5% of GDP would be needed to keep the debt-GDP ratio in 2035 the same as its level at the end of 2010, which was 62%. That is to say, federal non-interest spending would need to be cut by 5% of GDP, or federal taxes increased by that much, or some combination adding up to 5%. And the longer the adjustment is postponed, the bigger it becomes. Others have done these calculations with different objectives. For example, the International Monetary Fund came up with a figure of 7% of GDP. Now, all of these adjustments are large, but the key point is that other countries have made adjustments of that magnitude or larger in modern history. The US deleveraging task is therefore achievable, provided the political will exists. Assessing the deleveraging effort so far. You've all heard about the recent political compromise to lift the legislated debt ceiling. That represents only a small start to what needs to be done. The compromise involved a first instalment of $917 billion in spending cuts, and creates a joint committee of Congress to come up with another $1,500 billion by the 23rd of November. If that committee fails, or if it succeeds but the Congress subsequently fails to pass that package by the 23rd of December, cuts of $1,200 billion will take effect automatically, but not until 2013. Now, these numbers may sound impressive, but there is less to them than meets the eye. For a start, they are sums of annual savings over 10 years, and they include interest savings as well as the savings in non-interest spending. In fact, the reduction in non-interest spending in the first year is a mere $22 billion out of total spending of $3,400 billion. And those figures could expand, will expand by the 10th year and as the second round of reductions comes into effect. But even then, it would not add up to anything like the kinds of adjustment figures that the Congressional Budget Office and the IMF have calculated. The other point to make about the deleveraging effort so far is that it is narrowly based and leaves untouched the most politically sensitive expenditure savings options as well as tax increases. This diagram shows the broad structure of US federal government spending, and the cuts so far, they concentrate on these areas, and especially this other discretionary, non-defence discretionary, which is only about 20% of the total budget. And even when you include defence, those two chunks are only 40%. They haven't done anything about this, what they call mandatory, which includes the social welfare programs, or what they call generically entitlement programs, which are Medicare, Medicaid and Social Security, even though these are the fastest growing components of the budget. And one test of the credibility of budget cuts still to come is that they should be more broadly based and include savings from the social programs. The deficit can also be cut by raising taxes, but to date this option has been vetoed by the Republicans. I think they are right to lean against tax increases, but given the magnitude of the task, I think it is difficult to envisage it being accomplished without any tax increases at all. I just want to touch on this issue that there is a widely held view among commentators that public sector austerity programs should not be attempted now because they would tip fragile economies into recession. Some in the US are even going as far as arguing that there should now be another dose of fiscal stimulus. These assertions are hotly contested on the other side of the argument. This is just a rerun of the arguments about the effectiveness of Keynesian fiscal stimulus that raged a couple of years ago. This time the argument is about the other side of the same coin. My own view is closest to the so-called supply-siders. I think that Keynesian fiscal policy prescriptions, if they ever work, are not likely to work in a balance sheet recession and its aftermath, which is what we have now. I accept that fiscal restraint could have short-term dampening effects on the economy, but these are a price that has to be paid for deleveraging, and I do not think that they would be fatal to economic expansion. In conclusion, I think, as I've said, there is no public debt crisis in the US at the moment. If there were, the Treasury would not be able to borrow at 2.2% for 10 years. What there was recently was a manufactured political crisis over the debt ceiling, which has further damaged policymakers' credibility. But that is something different from an immediate debt crisis. What there is a huge budget gap that contains the seeds of a crisis. This can be averted by strong, credible and timely policy action. One source of hope is that in the space of the last 12 months, the political consensus has gone from denial about the problem to acceptance that there is a problem to some action to address it, but a lot more still needs to be done. Overlaying the battle of the deficit is a battle of ideologies about the size of government, and therefore about the mix of expenditure cuts and tax increases. The outcome of this battle of ideologies should not be a matter of indifference to Americans or even to us here, for it will help to determine America's long-term economic vigour and capabilities. The question is, does the US become more like a European welfare state, or does it remain a relatively, with the emphasis on relatively, small government country? As for the future, I don't have any precise predictions. But I will say, do not expect any big bang solutions to the deficit problem. It will be a war of attrition, a war that can still be won as long as the political system stays the course and keeps taking meaningful steps towards deleveraging over the next few years. The next instalment in this saga will come in November and December, and we should expect more brinkmanship in the run-up to those critical dates of the 23rd of November, which happens to be set because it's the day before their Thanksgiving holiday, and the 23rd of December, which happens to be the day before their Christmas holiday. Then next year the fight will be taken to the election, which may well be one of the most important for a long time in setting America's fundamental direction. Thank you.
Thank you, Robert. I think we're now going to hear about the other side of the Atlantic, so we just need to quickly change the slides, and Oliver, would you just like to come on up?
Okay. Thank you, ladies and gentlemen. Almost 2 years ago, Robert and I predicted that the next big economic crisis would be happening on both sides of the Atlantic, and now we are, of course, witnessing exactly that. Tonight I'm going to predict how the current European debt crisis is going to unfold. Predictions are, of course, always difficult, and the added difficulty with the European debt crisis is that it's economic and political. If Europe's debt problems were confined to economic issues, they would be much easier to fix. But they aren't. Europe's economic issues involve a large number of discrete political actors. 27 EU member states and 17 Eurozone member states, each with its own head of state, government, parliament, some with constitutional courts. And then there's the European Parliament, the President of the European Council, the head of the Eurogroup, the High Representative of the European Union for Foreign Affairs, the European Commission, the European Central Bank, the European Financial Stability Facility, and the International Monetary Fund. And let's not forget that there are markets as well, and big institutional investors, ratings agencies, banks, insurance companies, lobby groups, the media, and individual companies. And that discussions about the future of the euro are held in French, German, English, Spanish, Italian, and other languages probably doesn't help either. All in all, we are looking at a system of enormous complexity in which no single institution or person is in charge of really dealing with the euro crisis. And this chaos, although fascinating armchair entertainment, makes it difficult to predict the future of Europe. Nevertheless, I'm going to take a stab at a plausible scenario. The topic tonight is, of course, Trans-Atlantic Fiscal Follies, the sequel. But I will also have to talk about monetary follies. And in any case, the distinction between fiscal and monetary policy does not hold any longer in Europe, now that the European Central Bank has become involved in the business of indirectly funding mainly southern European governments through sovereign debt purchases. Europe is not facing one crisis, but at least three separate but interrelated crises. They are interrelated, but they're not identical. And the first crisis is the most apparent, the debt crisis. Many European countries, and not just Greece and Ireland, but also stronger countries such as France and Germany, are heavily indebted. And the official average debt of the Eurozone stands at more than 85% of GDP. The European Stability and Growth Pact allows a maximum of 60%. That's a level that many economists regard as the most that a country can reasonably sustain without debt becoming a burden on growth. The second crisis is a crisis of monetary union. The European Union consists of 27 member states, and 17 of which share the euro as their common currency. Economists have long argued that such monetary unions between countries can work only in an optimum currency area, and such an area is characterized by labor mobility, price and wage flexibility, the possibility of horizontal fiscal equalization, and synchronized business cycles. The conditions in the Eurozone are, of course, far from these optimum conditions. On the contrary, Greece and Germany, or France and Portugal, share little else except their joint euro membership. And despite this, they are operating under the same interest and exchange rates. And these rates are too high for some members, while they are too low for others. And this is making it almost impossible to get monetary policy just right for the whole continent. European monetary policy will always favor some countries at the expense of others. The third crisis is a lack of competitiveness in the European periphery. There have, of course, always been structural differences in Europe. Previously, such differences in competitiveness were reflected in long-term adjustment of its exchange rates. And the slide you see here shows how strong these developments were by comparing the exchange rate of the German Marc to other currencies in 1963 and then 35 years later in 1998 at the eve of monetary union. What you can see is that there has been a lot of devaluation happening in Europe over this period of time, And you could see that, for example, for France, Italy, and Spain, devaluation was between 63 and 84% over the 35-year period. And I put the UK and US on the slide as well, so you can see that it was actually the strength of the mark. It's not just something that was just limited to some periphery countries in Europe like Greece or Portugal. It was really the unique strength of the mark, because the Germans, of course, had their experiences with hyperinflation during the 20th century. So they were always following a very tight monetary policy. So the massive devaluations that you see here on the slides against the German mark indicate, on the one hand, a very tight monetary policy regime of the old German Bundesbank, and of course also the high competitiveness and productivity of the German economy compared to the rest of Europe. European economies like Italy and Spain, but also France, they had to continually devalue their currencies to remain competitive with Germany. And actually, I would also say that thanks to the German Bundesbank, some of these European countries kept at least a little bit more fiscal restraint than they would have liked to, but they just had to, because otherwise the devaluation would have been even more catastrophic for them. So thanks to the Bundesbank. But then, once monetary union in Europe was introduced, such devaluations were no longer possible. No, they were all part of the same currency. They were all operating under the same monetary policy. So what should have happened then is that these countries, France, Italy, Spain, Greece, Portugal, and the others, they would have had to break with their old habits. That means they would have had to make themselves more competitive, because they could no longer devalue against the market. And in order to make yourself competitive as a country like France or Italy, what would it mean? It would have meant reforming product and labor markets, deregulating economies, really improving the whole system of governance in these countries. But sadly, this never happened. And then, in addition to the three simultaneous crises of debt, monetary disparities, and competitiveness that I just described, there is, of course, a fourth crisis waiting to happen, and that is the banking crisis, because Europe's banks are undercapitalized, and in their current state, they would not be able to absorb a sovereign default. The last round of the EU's banking stress test, tellingly enough, did not even attempt to model such an event. Remember that a few weeks ago, the European Banking Authority presented the results of its latest round of stress tests and came to the conclusion that all that Europe needed was an additional 2.5 billion euros and all the banks would be fine. Now, that's of course not true. That was a bit optimistic. And just today, the Financial Times in Germany has exclusively revealed that the head of the European Banking Authority is just writing a letter to the 27 heads of government asking for special permission to the European Financial Stability Facility to enable it to purchase these banks directly, not just any papers, but to actually nationalize, in effect, European banks to prevent a further banking crisis in Europe. So the economic problems for European policymakers are then compounded by the added complication of the political desire to persevere with the project of monetary union almost at all cost. If countries like Greece left the Eurozone, it would bankrupt many of their banks, and it would bankrupt many of the banks who have lent money to Greece. At least that's what France fears. Germany fears something completely different, that a departure of weaker Eurozone members would lead to a massive appreciation of the euro and undermine the competitiveness of German exports. And with exports accounting for almost 50% of Germany's GDP, the Germans rightly fear losing the competitive advantage of their subdued exchange rate. In effect, what the Germans are really doing with their exchange rate subdued and really reflecting the weakness of the European periphery is they're engaging in some weird kind of neo-mercantilism. At the same time, neither France nor Germany has an interest in permanently paying for weaker Eurozone countries. The French can't afford it and keep their AAA rating, and the Germans don't want to afford it because they don't want to be punished for their economic strength, which I think they only do have because of their subdued exchange rate and their neo-mercantilist policies. But anyway. So an analysis of all the specific national interests of all Eurozone member states would only show how different they really are. The Italians and the Spanish, for example, demand the introduction of Eurobonds, that's jointly guaranteed government bonds, so that they can pay lower interest on their own government debt. The Germans and the Dutch reject this because it would increase their borrowing costs. And here's another example. Inflation rates are moving in different directions in the Eurozone. In the last quarter, inflation went up in Germany, Belgium, Estonia, the Netherlands, Austria, and Finland, but it fell in all the other Eurozone economies. And consequently, there are calls for monetary tightening in some countries, while others need to avoid it at all costs. The Eurozone crisis is so messy because the interests of the different players are not only discrete, but they are completely incompatible. And worse, there is no one solution that would work for everybody. And this is the main reason why for the past 1.5 years, EU policymakers have only been buying time while glossing over the most acute problems of the Eurozone. First, they gave financial assistance to Greece so that its crisis would not spread to other countries. And then the European Central Bank tried to drive down yields on euro periphery debt by purchasing them on the secondary market. This strategy failed for Ireland and Portugal, of course. Both had to seek refuge under the umbrella of the European Financial Stability Facility. However, that did not calm bondholders' nerves for too long, and eventually the European Central Bank extended its bond purchases to Spain and Italy. And the latest figures from the European Central Bank are that the European Central Bank currently holds about 127 billion euros of periphery government debt. And there is, of course, a pattern in all of these policies. European governments and the European Central Bank get involved only when it becomes absolutely unavoidable to avoid imminent disaster. Then they act, and afterwards they go on holiday. And even then, they only do what is really needed to calm the crisis for a few weeks, namely the holiday, without really ever addressing the underlying fundamental problems. You're laughing, but that's the way it happened. Remember that 21st of July summit. They decided on some new measures for the EFSF, said Marcus, and please wait now till September, then we all get together and we'll all get it done. And then Angela Merkel went to South Tyrol and Nicolas Sarkozy went on holiday as well. That's how they deal with these crises. But they're never addressing the underlying fundamental problems. They're never dealing with debt, really trying to get rid of debt. They're actually piling more debt onto the existing debt. They never deal with the problems of monetary union, that it simply can't work. And they never really address the competitiveness divergence between basically Germany and the rest. And the question now is for how long this game can continue. Can Europe just be kicking the can down the road, or is there a limit to buying time? Will it eventually find a real lasting solution to its three crises? That's the question for Europe. And the answer to these questions is quite simple, I think. Yes, Europe has been kicking the can down the road, but it has reached a crossroads now. And it has reached a crossroads where markets are forcing a solution. They are forcing Europe to decide between abandoning the project of monetary union in its current form or moving towards a full fiscal and political union instead. And faced with this choice, I'm convinced that they will give up monetary union. I don't believe the euro will survive another year in its current form, mainly because of the diverging interests I described earlier. Markets are nervous about the ability of some European governments to service, let alone repay, their debt, and in my mind, rightly so. Greece is, by any account, bankrupt. Its debt to GDP ratio is so high that it will never be able to restore it to a sustainable level. The Greek economy is shrinking, unemployment is rising, and bar maybe 20% internal devaluation, which is completely unachievable without civil war, the country will not be able to compete with its European neighbors. A Greek default is absolutely inevitable. And Ireland has made progress, but it is still unable to finance itself in international markets at reasonable interest rates. And the situation is probably even worse for Portugal, which has not seen any productivity growth for more than a decade. These three small countries could, of course, be kept alive by Eurozone countries, by other Eurozone countries. But the crisis has now spread to the heavyweights of Italy and Spain. And the European Central Bank has been purchasing Spanish and Italian bonds to drive down their yields. And this has, of course, had for a time now the effect that was desired, but this effect has been achieved at a great cost. And despite this, the yields are already rising again because markets sense that in the end the European Central Bank is bluffing. In order to permanently save Italy and Spain, a massive extension of the bond buying activities would be necessary. However, this nuclear option by which the European Central Bank intervenes to the tune of a few trillion euros would not only be monetary madness, it would be politically impossible to communicate this to the stability-concerned Germans, Dutch, and Austrians. So what will happen once Italian and Spanish yields reach danger levels yet again? I think there will come a point when the Germans will simply cut the cord. They will not allow their currency to be destroyed by continued quantitative easing, because that's what it is, or more old-fashioned, it's money printing, nor will they be willing to give in to a transfer union and Eurobonds. And this leaves only one way out, and that is pulling the plug on monetary union. Besides, the political differences in Europe are so enormous that there can be no consensus for the alternative, and the alternative would be fiscal and political union. Now, perhaps you remember that the European Union tried to introduce a European constitution a few years ago. That process took them 10 years. They had to go to the Dutch and the French in referenda and lost, and the constitution was rejected. And then it was remodeled, and it's now called the Lisbon Treaty, and that failed once in Ireland. And it was an enormous process. It took a lot of political capital. It took 10 years to actually get this very modest treaty and get it passed in all European countries. So that was a relatively modest step towards integration. Can you now imagine driving this further and going that next step to full-blown fiscal and political union in the current crisis climate? If the Lisbon Treaty took 10 years, I think this is completely unachievable that we're now seeing the birth of a fiscal and political union in Europe. So it is difficult to forecast then what happens once the Germans pull out of the Union. But it is plausible, perhaps it is even probable, that they will establish a new bloc of countries. A bloc of countries that actually share their commitments to monetary stability and greater fiscal discipline. And this could be the new North Euro or the North Marc or whatever you may call it. And it could consist of countries like the Netherlands, Austria, Finland, Luxembourg, Estonia, and Slovakia. And this solution would, of course, be extremely painful to German manufacturers. It would require also a recapitalization of some banks holding southern European bonds, and it will, of course, lead to greater tensions within the European Union, no doubt about that. But on the positive side, this is the only solution that avoids the creation of a giant redistribution mechanism in Europe. It would make it possible for countries like Greece to regain competitiveness through default and devaluation. That's what they used to do anyway. And it would be a way for Europe to dig itself out of its current mess. And this is the only long-term, plausible way Europe could ever deal with debt, monetary union, and competitiveness. And it's a shame that they're going to exhaust all other possible alternatives before taking this only workable solution to their three crises. Thank you.
Thanks, Oliver. It may surprise you to know that Oliver knows people who are even more pessimistic than he is. No. Now to something closer to home from Adam Creighton. Adam.
Right, well, after all that bad news, I've been sent to cheer you up. I've even worn a more lightly coloured suit, which is more in keeping with the message. And if you notice, we're actually coordinated. Oliver's fully dark, reflecting his message, and Robert's half and half, because he was more cautious, and I'm completely light. So there you go. Okay. Donald Horne's famous 1964 description of Australia as the lucky country has continued to be borne out. We sailed through the Asian financial crisis in 1998, and the economy barely faltered during the global recession of the early 2000s. And as for the financial crisis of 2008, the fact that we refer to it comically, almost mockingly, as the GFC is probably a good indication of how serious it really was in Australia. Today, the good story continues. Despite all the concern in the press, we are in a far better position economically than the United States or Europe. Our unemployment rate is much lower. Our governments, both state and federal, are not burdened with daunting debts. The Australian dollar is strong. Price inflation is relatively low, or certainly lower than in Britain and the United States. And our real interest rates are positive, which discourages excessive borrowing. With good government, I think, and also private prudence, that we can keep these benchmarks. Economic problems in Europe and America matter relatively less than they did for Australia, say 20 years ago. Australia's trade and economic future are increasingly bound up with Asia. It's no secret that China is our biggest trading partner now, having overtaken Japan a couple of years ago, but it's probably less well known that among Australia's top 10 export markets, 8 of these countries are Asian, and the US and the UK make up the balance. The dependence on Asia will only accelerate too. For example, Australia has recently signed a free trade agreement with the ASEAN countries, which came into effect last year. These countries, of which Indonesia is by far the largest, have a population of about 600 million, or about 100 million more people than the total of the European Union. The ASEAN countries' economic growth is twice Europe's, and their population growth rate is 14 times Europe's, although admittedly Europe's is basically zero. The Asian connection is not only growing in terms of goods and services, but financial markets are developing in Asia too, and this means that there are excess Asian savings to mop up our large current account deficit. Australians themselves are also modifying their behaviour in a way that makes us more resilient to economic shocks from Europe and America. Namely, we're saving more. Australia's saving rate has surged to 10%, up from minus 2% in the mid-2000s. It's not just the level of saving, but also where it's going. We're now more likely to save in safer assets like bank deposits rather than in shares and housing. This extra household saving puts Australians in a far better long-run position than continually engaging in debt-fuelled expenditure on consumption items. Higher personal savings rates also mean that Australians can better absorb, say, periods of unemployment, and they're better able to maintain their expenditures during economic downturns. But of course, as Oliver and Robert have indicated, another crisis overseas is indeed possible, perhaps even likely as large countries try to pay back their debts, or even if they try to evade them through printing money. The fallout could be felt in various ways in Australia. A precipitous fall in demand for our exports, or a collapse in the Australian dollar, perhaps an increase in the cost of credit on international financial markets, which in turn would push up domestic interest rates. All of these things could happen. We cannot fully insulate ourselves from these, but we can certainly prepare ourselves to better withstand them. I should say that Donald Horne's full remark, which I mentioned earlier about the lucky country, actually goes like this. Australia is a lucky country run mainly by second-rate people who share its luck. So it was actually a lot more pessimistic than is widely believed. Although I don't agree that we are run by second-rate people, either now or in 1964, our public spending is certainly second-rate. And in my view, this is where Australia can best change its behaviour to reduce any fallout from overseas. The good news is that the federal government does have a fiscal strategy. The May 2008 budget, this government's first, boasted the following. This budget ushers in a new era of economic responsibility, delivering a strong budget surplus and reprioritising spending to sustain growth in the long term. This new era had three prongs to it, which have been repeated in every budget since. First, to run budget surpluses on average over the medium term, whatever that means. To keep taxation as a share of GDP below the level of 2007, and to hold real growth in spending to 2% per year. The bad news is that these goals are very rubbery. Take the first goal, for example. Since coming to office, the government has brought down 4 budgets, and each has resulted in a massive deficit, including one in 2009-10, which was the biggest as a proportion of our economy since 1945. That was 4.3% of GDP, or $55 billion. That was followed last financial year, the 2010-11 year, by the biggest since 1993, a $49 billion, or 3.6% of GDP deficit. And I should note just in passing that a deficit of 3.6% of GDP would actually break the European Growth and Stability Pact if we were part of Europe. It's important to recognise, though, that government revenues have slowed significantly, and that's why I've got this chart up here, just to show you that, that to be entirely fair on the government, we have to recognise that what they expected in 2008 certainly did not occur, as you can see. But, of course, the government's massive stimulus package, which I'll speak more about later, was the biggest surge in spending since the Whitlam government, and that made the situation vastly worse, in my view. This financial year, we are expecting a sizable budget deficit again, and then next year, an increasingly unlikely tiny surplus of $3.5 billion, which I might add is less than 1% of government revenue. So if something changes along those lines, there'll certainly be no surplus. Of course, the government will say that its promise was to have surpluses over the cycle. Well, first, I would say to this that it's a concept that has little value in practice. I mean, what is a cycle? Who knows what the cycle is? When does it start and finish? It's a very rubbery concept. And second, even if we take the cycle concept at face value, then we're not actually going through a downturn. We haven't had a recession since the early 90s. The government's second aim is to keep taxation below 23.5% of GDP, which was the level in 2007. Now, this appears commendable, but it's actually a sleight of hand in my view. The real metric should be what is happening with spending as a fraction of GDP, because it's spending, because all spending must ultimately be paid for by taxation. And unfortunately, spending in Australia has been above 25% of GDP since 2008. indeed, it is set to decline further if you look at the budget papers. But like I said, the forecasting record so far has been very bad. So I'm not sure whether that will occur. Remains to be seen. That leaves me with the third aim, and I'll just get a chart up for this one. Okay, so the third aim, if you recall, was to keep real spending growth below 2%. So you can see what real spending growth has been over the past 10 years or so. So normally, to keep it below 2% would be fairly impressive. I mean, you can see during the Howard government that it was often 4% even, or certainly near 4%, and that's certainly not a good thing. But to claim that 2% is a good outcome after you've had such a massive increase is really not so impressive, at least in my view. It should be closer to 1%. And of course, the red line is a forecast. I mean, so that hasn't actually happened yet. So, even if we accept that 2% is a good figure, we can't get too excited about it yet. So rather than talk more in the abstract about the budget, I thought that I would volunteer some savings of my own tonight. Before I do so, I'll show a graph of federal spending and the breakdown. I've highlighted some of the large ones there for you. So total spending this financial year is estimated to be $366 billion, which is about a third of about a quarter of our economy, I suppose. Now, the reason that I'm doing this is because the opposition has recently come under pressure in public to come up with $70 billion worth of savings. Apparently, this is the figure required to pay for the coalition's promises to improve the budget bottom line in view of rescinding any mining tax, etc. The government has doubted the opposition's ability to come up with this figure of $70 billion, and a prominent commentator has even dubbed the amount unfindable. But on the contrary, it certainly is very findable. For one thing, $70 billion is over 4 years, so it's about $17 billion a year. So $17 billion of that massive amount is what is said cannot be found. So $17 billion represents less than 5% of annual spending. I want to show that it's possible to make cuts of that magnitude without taking a cent from core, long-established federal government programs like the age pension, the New Start allowance, the disability support pension, the pharmaceutical benefits scheme, Medicare, and funding for the states. I focused on health and welfare in my savings, but you can see that it takes up more than half of the budget. Education, health, and social security take up more than half of the budget. I focused on those three areas for my savings, and I haven't looked at all the other stuff, although I'm sure that there are lots of savings there as well. So let me just bring up my table. I hope you can read them. So the actual particular items are not so important. It's more the fact that all of these programs, in my view, are very bad programs and would not actually impinge on any of the core things I mentioned earlier. So if I could just start at the top, and I'll extremely briefly go through them. So the first homeowners grant is one of my pet hates, I must say. I have a passionate dislike for it. It's basically a transfer of wealth, I think, from poorer people to middle-class people through the tax system, and it's also demonstrably failed in its aim to make houses cheaper, and it costs $1 billion a year. Now, technically it's funded by the states, but I think the Commonwealth could insist that it be withdrawn through use of a tied grant, so I have included it. Now, there's some family welfare programs there. Now, we already have a family tax benefit A, which basically pays families per child. Family tax benefit B is a strange beast which rewards mothers basically for staying home. It's taken off them if they earn any more than $20,000 a year. So, and the baby bonus, well, I'm sure you all know what that is, and you can form your own views about whether that's worthwhile. And then there are so many silly programs in that government department. I just chose one, the gender equality for women. Now, look, I know it's only $50 million a year, but $50 million is $50 million, and I think that's a ridiculous program. So then we get to fuel tax credits. So this is a huge item, as you can see, absolutely massive. I think it's maybe the biggest thing I've got on the list. So this is a program whereby businesses can basically get their fuel tax rebated directly by the government. I just think this is a very poor way, especially in view of having a carbon tax at the same time. So on the one hand, you've got a program that encourages use of fuel and costs $5 billion a year, and then the government is actually proposing to have a carbon tax at the same time to reduce the use of fuel. So it'd be far better, in my view, not to have the carbon tax, just to simply get rid of that program. And of course, a lot of those businesses would then pass on their costs, just in the same manner that the carbon tax is supposed to operate. So the education tax refund, I think, is blatant middle class welfare. It allows deductions for personal computers, shoes, and stationery, among other things. The health programs are all pretty much nanny state raise awareness campaigns. They're not actually kind of helping anyone in particular. Now the industry support I've put there, but the Productivity Commission has actually estimated what that is. It's $3.7 billion a year, and that's just the budgetary, the direct payments. That's not all the tax concessions. That's just the direct payments to businesses in Australia to keep them afloat. And I mean, basic economic theory says that sort of thing is very bad and should be phased out. The sad thing is it's actually due to increase. And actually, another interesting point too that I was really struck by is that 27% of this industry support goes to the primary industries and mining industries, which is rather bizarre given that they're both experiencing significant booms, 27%. And also 46% of the assistance goes to services, which are not tradable. So, you know, the justification for assistance, at least in general, is that it's to help industries compete with overseas, you know, to level the playing field. Well, with services, there's no a playing field overseas because they're here. Of course, I'm not expecting. Sorry, I should say first that if all of these savings were enacted, then we could all, well, at least workers, could all be $40 a week better off if all the money was used to cut income tax. So that's basically what that equals, $40 a week for every worker who's paying tax, which I think is a very significant amount and would be a huge boon for the economy, huge, if suddenly everyone's disposable income went up by that much. Of course, I'm not expecting such cuts to materialise. In my view, vested interests and political timidity are far too overwhelming for cuts like this to be made. In fact, I fear the opposite is more likely, that we'll have another stimulus package. And this is my greatest fear in a fiscal sense in Australia. And this would be very disappointing as the first package was very damaging and wasteful, and it was based on an ideology that is Keynesianism that is, in my view, that evidence and logic has routinely refuted. So before finishing up, let me show you a couple of graphs to make this point about the Keynesian stimulus that we had. Of course, as we get further away from the GFC, we can more easily see what impact the government spending had. So the first chart I'll show you is this one. Now you can see here, this is just taken from the ABS. So it's very basic. We've just got gross disposable income in the blue line, and our consumption, which of course is meant to increase with a stimulus, is the green line. And you can see very clearly that everyone's disposable income went up with the $900 checks and so on. All the borrowed money went to people, and they obviously had more income suddenly over the 2009 kind of period. But of course, consumption completely didn't change. Now, I mean, you would expect there to be some bump, surely, if you subscribe to the view that the stimulus worked. Now, of course, you can always say, oh, it would have been far worse, but I just find that a pathetic counter-argument, really, just to say, oh, it would have been worse. I mean, I think those graphs are very telling. Now, secondly, you know, we had the BER, the Building the Education Revolution, which was also funded with a lot of government money. And so you can see here, this is the value of construction in Australia, the private sector at the top and the public sector at the bottom. And now these lines obviously bump around a lot more, but you can basically see what's happened, at least in my view, is that the resources used to build all the halls were sucked out of the private sector. And so the private sector spending has dipped, the public sector one has surged, and of course now that the program is finishing, it's kind of going back to normal again. So basically all that's happened is that the private sector, a building that would have occurred, never occurred, and we have a lot of school halls instead. So I think that's also a very telling graph. Finally, my last major point is that you'll often hear, oh, Australia's public debt is so low, it's only 7%, so we've got plenty of room to, you know, to spend, at least to try to stimulate the economy. It is indeed true that our net debt to GDP ratio is quite low. It's about 7%. In the UK, I think it's about 80%. In the US, it's about 70%. So, you know, enormous differences. But it's also very important to keep in mind that, you know, these statements about debt are cast in terms of fractions of GDP, not fractions of the size of government. And so in Australia, we have generally a smaller government sector, especially at the federal level, than in Europe. So I mean, it's wrong to gauge the size of a debt kind of over the economy. I mean, if we're trying to look at how difficult it is for the government to service the interest, then it's really the size of the government to the debt that is the relevant comparator. And secondly, and I think one of the other speakers mentioned this, Australia pays much higher interest rates on our debt than larger nations overseas. So, for instance, the Australian government can borrow for 10 years at 4.5%, whereas the US and the UK governments, for instance, are still borrowing at about 2%. And so by way of example, interest payments absorb about 3% of Australia's revenue, whereas in the US they absorb about 12%. And yet the US's debt is many, many magnitudes higher than that ratio would suggest. So In conclusion, I just want to say that to shock-proof the economy, it's best, especially for a medium-sized country like Australia, to keep our public debt burden low.